Okay, so picture this. You have a little bit of money in your savings account, barely earning anything, and you need to figure out this whole investing thing. Today, we're talking about how to start investing for beginners. I'm going to walk you through everything you need to know on making your first investment. Most people think that investing is this super complicated, risky thing that only Wall Street professionals can understand, or that you need thousands of dollars to get started. But here's the truth, investing is actually pretty straightforward once you understand the basics, and you can literally start with as little as $100. I'm Alice, I'm a CPA, and over my 10-year finance career, I've worked in private wealth consulting and in tech. And in this video, we're talking all about stocks, the different types of stocks, investing strategies. I'm going to walk you through analyzing a real company, Apple, live, step by step, show you how to read stock charts and financial statements for investing. And by the end, you'll have everything you need to know to make your first investment with confidence. When we talk about investing, we have to understand risk because different investments carry different risks. Depending on what you're investing your money in, you are, the definition of investing, accepting a risk of potential loss of value. So if you cannot accept a loss, then you should not invest. There's something of what we call a risk spectrum when it comes to investing. So on one end, we have lower risk things like CDs or T-bills that are basically a way to park your money for interest and give you a small return. They're considered very low risk. And then just one category above that, we have things like index funds and mutual funds. And then we have stocks. And then we have high risk investments that involve trading on margin, short selling, day trading, timing the market, put options and call options. It's been studied time and time again that people who do high risk trading, they end up getting less than S&P 500 returns over a long period of time, and that most day traders don't make any money. Just something to keep in mind as we dive into today's video. There's a very famous quote by Warren Buffett, the world's most famous investor, where he says that the goal of investing is to not lose money. And in that phrase inherently is the understanding of risk. But before we dive into analyzing Apple, there's something about stock sizes that most people get completely wrong. Stocks are categorized by something called market capitalization. Basically, that's how much the entire company is worth. And there are four main categories, which I'll get into a sec. But market cap is basically current market price of a stock multiplied by the number of outstanding shares that have been sold to the public. So if a company has 30 million shares outstanding, trading at $20 each, that's a market cap of $600 million. So the four main categories are large cap, mid cap, small cap, and micro cap. The category that the company falls into basically tells you about its long-term prospects. Large cap companies are very rock solid businesses, and they are very reliable in terms of investing and are generally considered safer investments. They don't have as much room for growth compared to a small cap company, but for a small cap company, that growth is also tempered by smaller market share and fewer assets. And many of these small caps or micro caps, they can easily miss the mark and disappear overnight. So large cap companies are companies with a market cap of over $10 billion. So think about Apple, Nvidia, Microsoft, Disney. Okay, these are more stable companies with slower growth, by definition, lower risk and lower potential returns. Then we have mid-cap companies. These are between $2 billion to $10 billion. These are growing companies with more growth potential than a large cap. They have moderate risk and return, and there is a balance of stability and growth. Then we have small cap companies, which are those that are doing between 300 million to 2 billion. They are typically smaller new companies with high risk, high potential returns. And the companies themselves and the stock prices tend to be much more volatile. But because of that, there's also more upside as well. And then micro cap is anything under 300 million, which is even smaller than a small cap and even more volatile in terms of risk and return. Another way you can understand market capitalization is in reference to real estate. So a large cap stock is like buying a house in a very established neighborhood. Stable, predictable, but it probably won't double in value overnight. Small caps are like investing or buying in an up and coming area. Could be amazing, but it also could be a bust. So for beginners, I usually recommend starting with large caps because they're less likely to have wild swings. And to be honest, people that are rich and have very large sums of wealth still invest in large cap stocks because they typically see markets as a way to preserve the wealth that they've already created. Apple, which is our example today, is a large cap stock with a market cap of about $3 trillion. It's one of the largest companies in the world. Understanding market cap is huge because you'll know by looking at the market cap whether a company fits into your investment strategy or not. Now let's talk about the two key types of investment strategies. There is growth investing and there is dividend investing when it comes to stocks. And it's truly up to you which one that you want to pick. But for growth investing, This would be focused on companies that are expected to grow faster than average. These are companies that typically reinvest profits back into the business instead of paying dividends. They have higher potential returns, but they're also more volatile. So some examples are Tesla, Amazon, and Netflix. And then on the other hand, we have dividend investing. So the dividend investing strategy is when you're focused on companies that pay regular dividends to their shareholders. This leads to more stable, predictable income, and there will be less growth potential, but also steadier returns. So these are companies like Coca-Cola and Johnson & Johnson. They've just been around for so long, and they're like household names. Whether you choose growth investing or dividend investing is truly up to you and your own financial goals. Depends on your age, depends on your risk tolerance, depends on how close you are to retirement, whether you want regular income, whether you can handle volatility and risk. It's all up to you. And you don't necessarily have to choose one strategy over the other, right? But just understanding the difference that there are dividend stocks and there are growth stocks will help you make more intentional choices when it comes to picking stocks and building your portfolio. So let's take a look at the Apple stock chart. This is on Yahoo Finance. As you can see here, we have the x-axis, which is time, and price. So we have the ability to basically drill down and see how the stock has performed over a 1 day, 5 day, 1 month, 6 month, 1 year, 5 year, or total time that the stock has been around. I personally like looking at the 5 year because it gives a nice time horizon and enough data. And you can see here, we can take a look at any specific day and see what the stock opened at. Okay, so what the stock price was trading at the beginning of the day, the highest amount that the stock ever traded at that day, the lowest amount, as well as what it closed out at, and also the total volume of shares that traded on that particular day. So one thing to take a look at with the 5-year stock is just the overall price trend. And as you can see here, it has been going upwards slowly over time. Another thing we want to look at is how the stock has responded to dips in prices. So you can see here that there's been some dips, but the stock has been able to come back quite quickly. There's been some dips, but again, it's been able to recover back quite quickly within a period of a couple of months. We can also drill down into the 1 year, and with the 1 year, specifically with Yahoo Finance, we can come in and see all of the different analyst ratings. So this is where all of the investment banks basically come and they analyze each stock and they upgrade or they downgrade their ratings. So if you're interested in that sort of information, you can find it in the 1 year chart, at least on Yahoo Finance. So Apple, as of today, I'm filming this on June 24th, is currently trading at $200.30. The market cap, which again is the share price times the number of shares outstanding, is just under 3 trillion. And the reason why market cap matters is because it shows company size, right? Apple is one of the largest companies in the world with a $3 trillion market cap. The stock price as of today is $200, but with these stock charts, we're also looking for the price trends over time, not just the current price. Volume is something really important to look at, especially if you're looking at small cap stocks or micro cap stocks, because high volume stocks trade more often, right? There's just more activity, and low volume may indicate that there's a lack of interest or a conviction in the stock prices movement. So you want to watch out with anything that's low volume. It's not bad per se, but what happens is you can get trapped into the stock if you want to sell. So say, for example, you're looking at a stock, hypothetical example, okay? Making up these numbers, and the volume says 50,000, 50,000, and you have 100,000 shares. Well, you're not going to be able to sell those 100,000 shares because there isn't enough demand of people who want to buy your stock. So you can get trapped in a stock if you want to sell the stock, if there isn't enough volume. So volume isn't going to be an issue with large caps like Apple, but it is with micro caps. So just watch out for that if you are trading or buying smaller stocks. PE ratio. So the higher the PE ratio, the more expensive the stock, and the more that the investor expects the stock is going to grow. And that expectation is like priced into the stock, right? PE ratio in of itself doesn't actually tell you that much. I know some people will say, oh, if PE ratio is below a certain number, that's good or bad, but you actually have to look at it in relation to the whole company as well as its competitors. So if you're looking at Apple because you want to invest in tech, then you would want to look at the PE ratio of the entire tech sector or the entire tech industry. And you also want to look at the PE ratio of Apple's competitors, Google, Microsoft, Amazon, to give you a better picture of what the PE ratio actually means. Another thing you can do is look at the historical PE ratio. So what was the PE ratio of Apple 5 years ago compared to today? And For Apple, it was much higher back then than it was today, because back then Apple was considered a huge growth stock. It's stabilized a little bit more, but historical PE is also something to look at and note. Same thing with EPS. EPS is earnings per share. So in theory, the higher, the better. But we also want to put it into context in relation to the industry, which is for Apple, the tech sector, as well as their competitors. Intuitively, we know that Apple is a very profitable company anyways. Dividend yield. So Apple pays a really small dividend. I think in the past I've made a couple comments saying that Apple doesn't pay a dividend, and that's incorrect. They do now. There was a period where they didn't pay dividends, but they do pay a very, very small dividend, 0.52%. And the ex-dividend date, if you are buying stocks for dividend investing, you want to take a look at the ex-dividend date, because if you buy a stock after this date, you are not entitled to the next dividend that the company is paying. Okay, so within Yahoo Finance, we can also drill down into their financial statements. Now, I know a lot of investors skip this, but because I'm an accountant, I always look for this, and happy to kind of share my thought process when I'm looking through something like this. But there are a couple of things that I think are always worth looking for when it comes to investing, especially in a position where you're trying to protect, your own money. So the first is revenue growth. It's always a good sign if a company is growing in revenue year over year. And as you can see here, over the past 5 years, or over the past 4 years, Apple has grown their revenue. They had a slight dip in 2023, but overall it's going up. Profit margins. So without pulling out a calculator and starting to do math, we can see that their margins have been going up relative to the revenue growth. So that's always a good sign. So based on their numbers here, we can see that their performance over the past few years shows steady, consistent growth. Operating income, which is an accounting term, has gone up consistently, but if we also look at normalized EBITDA, it's gone up consistently as well. Apple makes a majority of their money from their product, right? Their iPhones, their iPads, their MacBooks, and then the remaining amount of revenue is from their services like cloud storage, Apple Care. So under the analysis tab, we can also drill down into the EPS trends. Again, EPS is just like how profitable the company is relative to each share that they've issued. So if it's going up, it's always good. And you can see here, based on the current estimates, it is trending upwards, although there has been some fluctuations in the past. Okay, so moving on to the balance sheet. Now, Apple is a very mature and stable company against one of the biggest companies in the world. So there's not a ton to check here. And, we generally, if you take a look at how much cash they have, it's like over $65 billion, right? But where we can dig a little bit deeper is under the statistics tab. If we go under valuation, here we can see the trends in the market cap and enterprise value. Overall, it's been a stable company in the past year. So a lot of these numbers have already been analyzed for us, which is great. But one thing I just wanted to point out is debt to equity, which is 1.4. And for reference sake, I actually opened up the Microsoft stats as well. And I can see here that their total debt to equity is 0.3. So just one thing to note, that Apple is more heavily using debt to grow as opposed to Microsoft, which is one of their biggest competitors. But they also have a ton of free cash flow as well, operating cash flow. And so does Microsoft. Okay, so those are the numbers. Qualitatively, what can we say about Apple as a company, right? We know that iPhone dependency isn't going away anytime soon, okay? Because users of iPhones are loyal. Their services are also super sticky. For example, like cloud-based storage and Apple Care. How Apple gets you is that they get you to buy the product and then they lock you into their services, right? You buy the iPhone and then you commit to Apple Care for 3 years. And they also make their ecosystem so seamless that once you are Apple, it doesn't make sense to buy anything that's not also Apple, because all of your information, all your data is automatically streamlined and it's just so seamless with the touch of a button, right? Okay, so now that we talked about the basics, I also want to cover how to actually buy a stock, the step-by-step. So the first thing you're going to need is you need to open a brokerage account. The main three in the US are Fidelity, Charles Schwab, or Vanguard. And there are also some smaller ones as well. You have a few options. You can either open a taxable account, meaning that there are no tax advantages. So any income that you earn, you have to pay tax on that. There is the IRA, which is an individual retirement agreement that has multiple tax advantages. And so you would probably prefer that over the taxable account. If you have an employer, they may or not offer a 401k or a 403b. And you can either make a Roth or a traditional contribution. So a Roth contribution means that you pay tax today on your earnings, but the growth is tax-free. And a traditional contribution means that you pay less tax today, but any growth or earnings that you make on your investments, you're going to have to pay tax on the withdrawal. And then the third step is to actually fund the account and deposit money into the account. All of these three providers, Vanguard, Charles Schwab, and Fidelity, will have their own process on how you can link up your own bank account and transfer money in there. It's very similar to transferring money from one bank account to another bank account. And then you want to pick your investments based on your goals. Ideally, investing time horizon is long-term, like 5 years or more for stocks. No, this is just what I personally believe in, but to each is their own. And then you also want to think about your investment strategy as well, whether it's going to be dollar cost averaging or lump sum investing. I recommend dollar cost averaging, especially for beginners, where you're investing the same amount regularly every time you get paid because it becomes a habit. And when you do it this way, you're not subject to short-term fluctuations in stock prices. Remember that learning how to invest is very similar to driving a car or doing anything for the first time. The goal is to start learning and to start building the habit, and you can always adjust and make changes as you gain experience. So just to recap what we covered today, we talked about the different market cap sizes. We covered growth versus dividend investing strategies, and we did a short analysis of the Apple stock, looking at both the stock chart as well as the financial statements of the company, as well as a qualitative analysis of where Apple is going. And the most important thing to remember is that with investing is that it's not about picking the perfect stock. It's about starting, learning, and staying consistent, because every successful investor has started exactly where you are now. If you guys enjoyed this video today, you're going to love my other video on the differences between index funds, mutual funds, and ETFs. And in that video, very similar to this video, I do a deep dive of each of these three. I talk about the key differences and what you want to consider when you are making a purchase between one of these three. If you like this video today, make sure you check out that video up top. Hit me with a comment down below on what you liked with this video, whether you have any questions, and I'll see you guys in the next one. Until next time.